Hi, this is Liqian Ren, Director of Modern Alpha Wisdom Tree ETFs. Welcome to China of Tomorrow podcast series, where we navigate China, India, Japan, and the broader emerging markets with members of Wisdom Tree and other industry leaders. Hi, today is October 28th, 2024. Our episode will be posted on Halloween on the 31st. So actually, it's a good topic to talk about China. Over the weekend in Shanghai and Hangzhou and a couple cities in China, there was a little bit, I would say, back and forth between the young people who like to dress up using an American holiday as a kind of, I wouldn't say protest, but kind of releasing, their useful innovation and this dissatisfaction and this, some fun. And because it's a congregated, days, and the government is clearly uncomfortable, I would say, with so many young people on the street. So in Shanghai, you saw social media posts about some of the people who dress up with a little bit controversial characters got kind of led by the police, not necessarily arrest. In Hangzhou, actually, what I, from limited information, is that the police put a lot of the people they feel it's a little bit too much in the hotel lobby. And actually, a lot of them started streaming live from the hotel lobby, because a lot of those young people who actually go and dress up elaborately is also partly for their social media accounts. So I so far I haven't heard much formal arrest. It's much more about the government. I think feel a little bit of pressure, and the local governments feel pressure. And in some way, I would say it's good. You have this city competition going on. People are not very happy with Shanghai's a little bit more heavy-handed than the Hangzhou and the Guangzhou, even though there are also a little bit more heavy-handedness going on there. But I think this is a good leadway into how we think about China. So there are really two things, and this is what I tell people in private as well. So I give the same message whether it's private or public. That the general baseline for China is that unlike in the U.S., most of the time U.S. equity market goes up, and you just gradually put in your money day by day. It's a pretty good strategy. China, a significant time in China equity is in bear market, in the sense that, and then you have this huge, very quick policy driven rallies, which are very difficult to catch unless your shop or is in macro trading, because a lot of these policies really came out of very few people at the very top. And then unless you have the infrastructure, the traders, in place to catch these, it's very difficult to make a play. So for people who actually, is much more longer term investment, then you have to, and you want some China exposure, you have to really, live with this very long negative sentiment. Sometimes, goes down even more than what you think it's already going down. And then, to be able to catch those huge, quick, very really out of nowhere rallies. Again, so that's the baseline. The second baseline is, I think maybe people who follow me now have heard me say this many times. Generally, almost every story on China in English or outside China is going to be negative. That's just the current, political environment. Obviously, there are good things happening in China too, but again, there is a bit of, media spin, and then most of the angle is going to be negative. But think about the opposite side of it. If every headline is negative, then China doesn't need to be perfect to be able to beat the expectation, because the expectation is so low. So I think even though I myself, is aware of these dynamics, and I think even I myself was not um, aware of these dynamics much that, to actively take into account of this. So I think in terms of China, that's a general baseline. In terms of the next 3 to 6 months baseline, then it's very much driven by three things. One is U.S. presidential election, and then second is the Fed, because the faster the Fed lowers rate, the more monetary rules that China has. Because China right now is in a kind of a low rate environment, and unless Fed moves and China moves it correspondingly, or else your difference of the rate will increase, and then that will put pressure on Chinese currency. So China is very aware of this, and I think every central bank is aware of this. And I think people in the U.S. Have this benefits that you don't have to worry about the currency, because the US dollar is the world currency. But every other country have to thinking about its relative position against the US dollar. So I think that will impact, China. And then third thing is the domestic. So that's why you will see that China will act after both the Fed and the US election clarity. And it does have an implicit government like a put. There's a fund that could potentially be used, and they have been using it to buy up China A shares. Can they buy the HK market? I think that one is not very clear. I mean, technically they could, but I think because China has a much more capital control over the mainland, so the bang of the bag, buck, using money to buy up the local shares is easier because of liquidity and all the other constraints. So because of that, I think in the short run, you will see China continue to lower the rates as Fed lowers rate, as long as it can keep the exchange rate stable. And if a U.S. election brought significant volatility to Chinese equity, at least the local market will have. So that is when we are thinking about building our X data on China index. We have about 31% local shares in it, which makes our strategy, our index quite different from other existing China themed indices or strategies. So I think again for that, it's general in the next 3 to 6 months. The real economic data is not going to give clarity, mainly because now both US and China are getting into holiday season, and we've already seen some indications that a lot of the US importers are speeding up imports from China because the worry of President Trump's 60% tariff on China. And also Chinese New Year, February, usually screw up, really mess up a lot of the January, February, March data. So in China, again, people do spend time trying to correct these seasonalities, but it's really difficult to correct them perfectly, so that the clarity on the data is not going to be as informative. In terms of fiscal stimulus, and also I think there are a lot of kind of talk on, is it going to be 1.5 trillion, 2 trillion, and 3 trillion? And I will say all these are guessworks. Actually, China probably hasn't even decided. They maybe have a range, like between 1.5 to 4 trillion. But it's going to be very dependent on what happens to the Fed and what happens to the US election. And a lot of these Chinese policies are really decided by 3% in the room. So I think, if you put in the number, if you put the knife on me and say a number, I probably say 2 trillion, because that's like the middle point. And, but it can go for 3 trillion easily if you if you see significant risk coming from the US side. So I will say, I think the number itself is not that important. The important thing is that China has some goals. So, for example, the PBOC says it's going to put inflation as a very important factor in its decision making, which is kind of almost saying that it's like US Fed cares about the inflation and the unemployment rate, and China right now is also caring about the unemployment rate and the inflation rate. The opposite side. In China, inflation was too low and the unemployment rate was too high. The US right now is, inflation now is less of a problem, but inflation was on the higher side, and unemployment rate is, gradually, I think, ticking up. But Fed is trying to, do a soft landing. So again, with all these put in together, I think in the next couple of months, it's a really good time to think about it, like how much China you want in your portfolio, how much risk you want. Do you want to go with emerging market ex China plus some China kind of framework in your portfolio? As that's what a lot of people are doing. But then you're gonna have to make a decision how much China you want, or you want to just go with emerging market, the typical emerging market, weight. You can have a growth oriented portfolio where China weight will be slightly above average or close, or in the value weighted portfolio, China may be slightly lower than the average. It depends on how the strategy, how the portfolio is built, and agnostic of each country's weight. So we have a slew of strategies that ranges from 0% China weight to about 10% to about 30%. So ultimately, I think people shouldn't fear of losing out on China. That's what I know. It's a 3 weeks ago, it feels so far away already, that at that time when China has this huge run up, and one of the factor, I think, either Goldman or one of the brokerage firm thrown out was that people are going to fear of losing out on China. And I would say, don't fear of losing out on China, because there is a lot of risk associated with China, and then that means there are a lot of opportunities you could use to build up your portfolio. You just have to be really patient and know how much. And the last point is geopolitics. I think it is generally true that India and Japan will benefit from China, but we also need to be aware that ultimately it's what the U.S. interest lies that decides the balance between China, India, and Japan. And U.S. has way more cards that it can play. So, for example, if you notice that recently, actually, there are some quite negative headlines on India. And some of the headlines, actually, I was joking to friends that if you replace the name India with China, you that's the usual headline, usual news you see on China. So there was some news about Indian company that has sold the computers and the chips that comes with computer to Russia. There was a news article questioning India's growth estimate. So all this is partly geopolitical, right? China and India made a deal on the border that would benefit both India and China. And from U.S. point of view, it doesn't want to be dependent on China, but it also doesn't want to depend on India either. If you look at what the U.S. effort is, it's trying to build manufacturing in the U.S. So obviously, it needs help from its allies, in Western Europeans, which are mostly more allies, and India is, I would say, it's kind of semi-ally to the U.S. So I think under this kind of geopolitics, you cannot rule out China completely. If you just want, extra China from your whole portfolio, then you're gonna have to, also live with the kind of risk that China could do well. Because really, if you look at the current situation, China is making quite a stride in its technology innovation and upgrading. And in terms of that, like in terms of industrialization, India is still years behind to capture that kind of market. So I think having some China exposure in your portfolio will help both as a hedge and both as a to catch some of the hard rallies. Just make sure when you build a portfolio, you really be patiently build it, not just go in. So anyway, a lot of things happening in China, and Halloween is a great holiday for my kids. Love Halloween, and so I think in China, a lot of young people also love Halloween. So it's a great time to think about all these economics and social interactions happen. So I think in terms of China, we'll continue to bring a lot of China related content that you can reach us on our website, on Twitter. I'm also on Twitter. I try to do that as much, even though because there's also other part of my job that limits the kind of time commit I have. But we always, like to hear from you in terms of feedback, in terms of the kind of things you are looking to hear us discuss China. We will have some book discussion with authors coming up in the next couple episodes. So just wait and give us feedback. Thanks.